A Chinese business license can make a foreign-owned company feel finished. The company has a name. It has a registration number. It has a legal representative. It exists on paper. For many foreign founders, that moment feels like the finish line. But a business license only proves that the company exists. It does not prove that the company is ready to operate, bank, pay tax, issue invoices, hire staff, or support a foreign founder's work status. This episode is about what has to be true after the license. Think of WFOE planning as a timeline, not a single approval. Before registration, the founder is already making choices that affect the later company. Overseas notarization, authentication, shareholder documents, address planning, business scope decisions, and capital logic can all shape what happens after the license is issued. Those early choices are not isolated paperwork choices. They decide what kind of company the founder is building for later use. Will the address support official contact and verification? Will the scope support the activity the company actually plans to perform? Will the capital logic make sense for the operating model? Will the company be able to build tax, banking, invoice, hiring, and founder status records without rebuilding the structure under pressure? That is why the license should be treated as a milestone inside a longer chain. The first timeline point is address reality. A registered address is not just a line in the application. It can affect official contact, tax handling, bank review, invoice handling, site verification, and whether the company looks operational. A low-cost address may seem efficient at the start, but if it cannot support the company's actual use, it can become expensive later. A false or unusable registered address can lead to abnormal business status, and abnormal status can affect banking, invoicing, contracts, and later procedures. The second timeline point is scope and capital. Business scope is not decorative language. It tells the outside world what the company is supposed to do. Registered capital should also fit the business model, credibility needs, and planned operating timeline. If the scope, capital, and real activity do not support one another, the company may be registered, but harder to explain later. The third timeline point is tax setup. The company does not wait for revenue before becoming part of a compliance system. After registration, tax setup, bookkeeping, filing rhythm, invoice preparation, and accounting ownership matter. This is where registration starts becoming operating discipline. The fourth timeline point is bank and invoices. A company without a usable bank account and invoice capability may exist legally but struggle commercially. Bank review may ask whether the company, address, business activity, responsible person, and funding story make sense. Invoice capability may depend on tax setup and accounting records. The fifth timeline point is founder work status. For a foreign founder who wants to live and work in China, company registration is connected to personal status, but it is not automatic. The company must be able to support a real role, an employment arrangement, salary or payroll logic, tax records, and business activity. A shell-like company may not be ready to sponsor the founder immediately. This is the point that often gets separated too late. Founders may register the company first, think about clients second, think about banking third, think about tax fourth, and only then ask whether the company can support their own work status. That sequence can work only if the early decisions were made with the later use in mind. If the company created in month 1 cannot support the personal plan in month 6, the problem was not only timing, it was design. Now follow the sequence. A founder registers a WFOE using a low-cost address. The license is issued. The founder is excited. They start speaking with clients and preparing to move to China. But several months later, the address becomes a problem. A review or banking check exposes that the registered address cannot support the actual operation. The company is marked abnormal. The bank account process stalls. Invoices cannot be handled smoothly. Contracts become harder to execute. Then the founder's own work status plan loses its foundation because the company cannot show a clean operating story. The founder did not fail at registration. They treated registration as the end instead of the start. The framework to save is after license. 1. Address reality. Can the registered address support banking, tax, official contact, and later verification? 2. Scope and capital. Do the company's stated activity and capital logic match the business plan? 3. Tax setup. Is the company creating a clean compliance record from the beginning? 4. Bank and invoices. Can the company receive money, pay expenses, and issue proper invoices? 5. Founder work status. Can the company credibly employ or sponsor the founder when the time comes? The main lesson: a WFOE license is a necessary milestone. But the real question is whether the company can function after the license. For a founder, early shortcuts often become later blockers. The lowest cost registration path is not always the lowest risk operating path. Owning a company in China does not automatically mean the founder can legally work for that company. That is where the next episode begins.